Now let's talk about the Indian markets. They're clearly feeling the Monday blues. There was a massive crash today. Both the Sensex and the Nifty fell to a 7-month low. They dropped by over 1%. No relief for the Indian rupee either. It's recorded its biggest slide in 2 years. $1 is now worth almost 87 Indian rupees. For Indian investors, 2025 has started on a rough note. Recent weeks have been all about dips in the markets. The overall sentiment is bearish, but what is causing this weakness? It is a combination of both domestic and global factors. Let's start with what's happening at home. Last week, we received some news about the Indian economy. The government has downgraded its forecast, its growth forecast. India will grow at 6.4% this year. That's what they've said. That is the new projection for the current financial year, the one that ends in March 2025. 6.4% is the slowest pace of growth in 4 years. The earlier projection was between 6.5 and 7%. Now remember, 6.4% still makes India one of the fastest growing major economies in the world, but this dip is worrying nonetheless. The Indian economy is showing signs of weakness. In the second half of 2024, inflation was high, investment was sluggish, and India's trade gap grew wider. Trade gap is the difference between imports and exports. When this gap grows, it's a sign of sluggish growth. It shows that a country is importing more but exporting less. This is also called a trade deficit. A higher trade deficit can be a bad sign for the economy. Indian corporates too seem to be struggling. We're talking about India's listed companies, those which trade on these stock exchanges. At least 45 listed companies could see their profits drop by double digits. This is for the third quarter from October to December 2024. Indian companies are complaining about weak demand, meaning fewer customers are buying their products. As a result, foreign investors have pulled their money. So far, they have withdrawn around $2.5 billion from the Indian markets. This is just for January, and we're not even halfway through the month. So that's the challenge at home. The Indian economy is also facing challenges from overseas. The US economy is showing signs of strength. Last week, we got fresh jobs data. America's unemployment rate fell to 4.1%, which is the lowest in 11 months, and this has surprised investors.
We saw the labor market report from the U.S. on Friday. It was unexpectedly strong. The unemployment rate has fallen and more new jobs have been created than expected. After Friday's strong labor market report, most major U.S. banks now only expect the Fed to cut interest rates in May or June.
America's strong jobs data is bad news for Indian markets. It could make investors park their money in the US and invest less in emerging markets like India. The trend also puts the rupee under pressure. India's Reserve Bank, or RBI, has tried to defend the rupee. It has been dumping dollars and buying up the Indian currency to prop it up. The RBI has been using up its foreign exchange reserves for this. In the beginning of this month, the bank spent around $6 billion to defend the rupee, but the challenge persists. Although it's not all bad news, there are some positive trends as well. India's retail inflation declined in December to less than 6%. This is a 4-month low. Food prices have dipped by around 1%. They're hovering around 8% now, which is still high. Overall, India's inflation rate is still above 5%. The RBI's target is 4%. So they will have to work harder to tame it. The days ahead will be challenging, and the current trends will test the Indian economy further.
From breaking news to the day's biggest controversies, shedding light on the world's top headlines, detailed analysis on the stories that matter the most to you. Catch it all on Spotlight at 6 p.m. India time and 12:30 GMT, only on Firstpost.